Good afternoon, everybody. My name's E.R. Anderson. I'm the Executive Director of Charis Circle. Charis Circle is the nonprofit programming arm of Charis Books, and Charis Books is the South's oldest independent feminist bookstore. We are located on the campus of Agnes Scott College, and we're excited to see several of our Agnes Scott College colleagues in the audience this afternoon. We are here today celebrating the book Moving Mountains, The Power of Main Street Americans to Change Our Economy. And we had originally scheduled this conversation almost a year ago, right at the beginning of the pandemic. And I'll say, I think this conversation is even more relevant now than it was even a year ago. Our economy has changed drastically, particularly for quote unquote regular Americans. So I'm really thrilled to have our conversation partners here with us today. So I'm going to introduce Pam Sugarman first. Pam Sugarman is the president of Sugarman Consulting, which offers strategy and governance consulting to nonprofits and foundations here in Atlanta. And Pam is going to be interviewing the author of Moving Mountains, Janice Shade. Janice is a social entrepreneur, financial innovator, and author with 30 years of experience building brands, businesses, and movements. After an early career in brand management at Procter & Gamble, Welch's, and Seventh Generation, she set out to explore new models for conscious commerce and community capital. Since 2006, she has launched or co-founded for-profit and nonprofit ventures, including True Body Products, Milk Honey, and Local First Vermont, all of which share common themes of democratic access to capital, economic justice, and local economic resilience. Janice is currently the founder of the Initiative for Local Capital, a nonprofit innovation lab, and a founding board member of the National Coalition for Community Capital. Moving Mountains, The Power of Main Street Americans to Change Our Economy is her first book. So welcome to you both. We're so glad to have y'all here, and welcome to everyone watching at home. Please feel free. I see Mina is already shouting out that she's watching from Philly. I hope other folks will shout out where you're watching from. Just a quick housekeeping thing. You can click this Ask a Question button at the bottom center of your screen at any time, and go ahead and put questions in at any point. And Pam will assimilate them into the conversation as appropriate. But we're thrilled to have you here. Got folks from Boston. That's great. So we'll go ahead and get going, and I'll get out of the way. So welcome.
Thanks so much for having us. We are thrilled to be here and to be hosted by Charis Circle and Charis Books, an integral institution in our community. And for me to have known Janice for many decades now, and to have watched as she accomplished building a life and building a career in a way that takes all of the parts and pieces of her history, and she's now pulled it not only into this book, but into this movement for local capital that has affected how I live my life. And I'm looking forward to sharing the conversation with Janice today. Janice, do you want to start by saying hello, or shall I just say hello, would you?
I'll say hello. Greetings from snowy, cold Vermont. I kind of wish I was down in Atlanta today, where it's probably a little bit warmer than it is here. But I'm really honored to be part of this conversation, and especially knowing how many folks are from the Atlanta area watching this. I've got some really interesting stuff to share you about all the great stuff that's going on where you are, as well as folks from all across the country. Lots of exciting things going on there too. So excited to tell you what I know.
Local capital and regenerative finance is something that's really important to me. And I was just wondering how did you write this book anyway?
So the book started off as a way for me to kind of process what happened after I closed my first startup business, where I learned so much about where capital comes from, the importance of understanding where your capital is coming from and what kind of capital you bring into your business, precisely because in the kind of the post-mortem of my company after shutting it down, realizing that I had brought on the wrong type of capital. And it wasn't because I didn't know any better. It wasn't because, it was because I didn't know any better, really. But I learned so much from that process. And part of the reason that it happened is that at that time, it was kind of the only capital that felt available to the type of business I was starting. And that mentality continues to this day. When I come across entrepreneurs, and I've talked to hundreds of them that find their way to me and want to know, how did you raise money for your business? Invariably they come thinking, I've got this startup and I'm either going to go get a loan from the bank, or I'm going to go get money from an angel investor who's going to write me a big check. And so a lot of what I talk to them about is how that's, first of all, that's a fallacy, that those two are even available to them, readily available, and that they are the right fit for the business. So the book goes a lot into both my experience raising capital for my first business, what happened with it, and then starts to explore what else is out there.
And the way I understand it, it's not exactly that the capital wasn't available, the right kind of capital wasn't available for your business. The idea is that the system hasn't yet been developed for that kind of patient capital to
yeah, exactly. So maybe I'll jump in here and tell a little bit about the story of what happened. So the business that I started was called True Body. It's a natural personal care products company. I have this huge background in consumer products companies. So I knew a lot about how to launch and grow a brand. I'd never actually put a company around that brand to start it. And that's what was exciting to me. And I started the business with a social mission that went even beyond wanting to start a natural personal care products, creating good, natural, environmentally friendly products. I also wanted to change some pieces of the natural products industry that weren't working in my opinion. That so many natural products are priced pretty high, and for good reasons usually. But there's this thing in the industry called the green premium, and it people kind of know it, and they say people are marketers who set the prices for a lot of these products kind of know, like, people are willing to pay more for natural and environmentally friendly products. And so we'll charge them that. I wanted to change that. I wanted to prove that natural products could be more accessible to a broader audience through their pricing and also through their placement in traditional grocery stores, not just Whole Foods, but in Publix and Kroger and places like that. So I set out to build this company with the social mission, and I wanted to bake my values into every aspect of how I started and ran this company, about how I produced it, the sourcing of ingredients, all those kind of things, and also where I got the money from to start the business. So before I'd even finished the business plan, I came up with this idea that I called my Million Moms idea. And this was back in like 2007, 2008. And the term crowdfunding it didn't exist in common conversation like that term. It's kind of funny to think back now. It wasn't that long ago that the term crowdfunding didn't even exist. So my thing was, okay, what if I went out and got 1 million moms to invest $1 each in my business? And I just love this idea of all these moms investing in a mom entrepreneur, easily accessible. It's $1, just invest $1, and that they would become my business partners as well as my customers. So I had this idea, and I talked to my financial advisor and my attorney about that. And I got this feeling that they wanted to kind of pat me on the head and say, "Oh, that's so cute, but you can't really do that." The legal structure as it stood at that time just made it prohibitively expensive to even try to do something like that. So they said, just go raise money the old fashioned way, go out and get angel and venture capital. So I did. And I launched my first capital campaign in October of 2008, which, if anyone remembers October of 2008, there's this thing called the Great Recession. Kind of made it a little tricky to be raising capital, but I did. It took me a really long time. And it was but I did it. And at the same time, I was still kind of experimenting with this idea of crowdfunding. Well, the whole story is in the book. If you want to read it.
Please do.
Yeah.
Pause the book quickly. Janice is not only brilliant and creative and entrepreneurial, she's also super funny and writes really well. So the book is like an easy read to get and fun to get to the points.
Except I hope I don't make you cry with my sad story of shutting down my business.
But look at us.
Yeah, but it's such an illustrative point about what happens, because really what happened was the venture capital investor that I eventually brought on to help fund the business decided, even though the business was growing at double-digit growth year on year, we had gotten into let's see, I see somebody from Oakland, maybe, I don't know if there's anyone on from the Pacific Northwest, if you know Fred Meyer. Fred Meyer is a chain of grocery stores and up in the Pacific Northwest, and it's part of Kroger, which is the largest grocery chain in the country. Growing like gangbusters there. Kroger came in and said, this is great. We want to roll out to all 3,000 of our stores, which would have been the tipping point, getting the product and the company to profitability. And in the end, they said, this is great. We're just going to bring it in next year at our next category review. So, in 12 months, your products will roll out with us. And the venture capital investor said, what? We've got to wait another year. They knew it would mean I would need more capital to keep going, to keep producing inventory. And they just said, we're pulling out. We're done. You can try to sell the company or shut it down. We don't care. And that was it. And so the company, I tried to sell it, came pretty close, but ended up having to shut it down about 8 months after that conversation. And mine is not an atypical story. It's very related to how venture capital works and their types of expectations. And that's why I say it was the wrong kind of capital for what I was trying to do. I was trying to build a business that would grow, create jobs, create good products, and be a contributing member of the economy. The venture capitalists wanted to grow it as fast as it can and spin it off for as much money as it could. So we were at odds.
Does that bring you to your favorite chapter of the book?
It does. This is a fun one to write, and I'm gonna let's see if I'm gonna try to share screen here, and I'm gonna show you. These are the quotes that I have on the first page of chapter 4. Chapter 4, the title is "Lifestyle is Not a Four-Letter Word." But these quotes, that the polar oppositeness of these two quotes really resonated with me. You have Milton Friedman, a world-renowned economist. He had been an economist with the Reagan administration, an advisor to Margaret Thatcher. He won the Nobel Prize for Economics, basically saying that the only social responsibility of a business is to just make more money. And this was back in 1968 that I think he wrote this, but it's become a bit of a mantra to a lot of those who believe that maximizing profits is basically the goal of a corporation. On the flip side, you have David Brower, who was the first executive director of the Sierra Club. He's founded numerous other environmental groups. He was nominated twice for the Nobel Peace Prize, saying there's no business to be done on a dead planet. And the interesting thing about these two men, they were born the same year, the same month. They were both born in July of when was it? July of 1912. 1912. And on opposite sides of the US, and clearly on opposite sides of the spectrum in terms of their approach to business. And I think that really illustrates what's going on here with those entrepreneurs and business owners who are trying to really think about the way they run their business, that are infusing social and environmental missions into everything they do, and realizing that they have a responsibility to be a good corporate citizen of the earth and the way that they treat their people and the planet and the resources they use and all of that kind of thing. And then on the other side, you have the folks who say, yeah, but if I'm lending you money or if I'm investing in your business, your job is to make as much money for me as you can. And so in this chapter, I really go into how kind of the mentality of venture capital and explain how, it's kind of a known algorithm for venture capital funds that their expectations are that they're going to invest in 10 companies in their portfolio. They're going to expect 2 of those to be just home runs. You've probably heard the term unicorn. It's the companies that really take off and end up getting sold to, Google or Facebook or whatever for bajillions of dollars. So they're going to expect 2 of the 10 to be those unicorns. And then they actually expect that the other 8 will either break even or just fail outright, and even or break even or slow growth. But even that break even or slow growth is in their mind is considered failure because it's not hitting that trajectory. So they plan their investments accordingly. And when they see a business that's not hitting unicorn trajectories, they basically just leave them and focus on the ones that they think are going to make it. So what this means is that we have an awful lot of businesses out there that could be perfectly viable, profitable businesses that are not getting funded or are underfunded or are just being left in the lurch because of the expectations of venture capital. So that's the problem that I'm setting out to try to change.
So the quotes explain it really clearly oh yeah, that makes perfect sense. So then talk about how, if that's the problem, where the solutions?
Yes. So the solution is to find those investors for whom their expectations are more aligned with these businesses. I see a lot, kind of to get back on venture capital. I'm sorry, I'm going to beat up venture capitalists a bit today. But there's a lot of news coming out in the last several years about how dismal how dismally low the amount of venture capital is that goes to women and Black and Hispanic owned businesses or Latinx owned businesses. For women, it's, around 2% of venture capital goes to women owned businesses, less than 1% to Black owned businesses. And no one's even tracking for Latinx owned businesses. So it's got to be really small. And so the answer then is that, well, we need more women and Black and Latinx investors in venture capital to even that out and to start to, bring more money to those businesses. I'm going to shoot that one right down because of the very nature of venture capital itself, and the fact that also that most women, and I can find stats on women. I can't find a whole lot because no one's tracking it for Black and Latinx people, businesses started by people of color. If anyone out there has stats, please send them to me. But the types of businesses that these entrepreneurs start are really not a good fit for venture capital. Venture capital, I listened to a great webinar almost a year ago by 2 venture capitalists, and they were talking about the future of venture capital and where they saw it going. And they weren't very optimistic. Basically, they said, if you have an established venture fund that's already showing success, the place for you to go is to invest in health tech, health tech, and biopharma. Those are the industries that they want to invest in. They said for new venture funds starting out, they said the uphill climb is so difficult in the current climate that you might like why even bother was what they're saying. But the interesting, the salient point here is that the kinds of businesses that venture capital wants to invest in: tech, health tech, biopharma. About 3% of women start businesses. 3% of women entrepreneurs are starting businesses in those areas. The vast majority of those women are starting businesses like mine: consumer product companies, retail, wholesale, health and wellness related businesses. And so that's where the disconnect comes in. So what we are starting to see now is the rise of crowdfunding. That's been, unfortunately, the regulatory changes that came about to help enhance crowdfunding came about a little too late to save my company, but that's okay, because what I've been doing is to start working on helping create these new sources of capital for other businesses that are starting like mine. So back in 2012, President Obama signed in the Jobs Act, which was that got the ball rolling for regulation crowdfunding. It took until 2016 for the rules to actually come into place. So on a national basis, regulation crowdfunding, or Reg CF is the short term for it, has been available to businesses for about 5 years now. It's had a pretty slow start. When I wrote most of the book in 2018, 2019, and the statistics that I found at that time were showing that it was, I think I found that in 2018, fewer than 150,000 investors had invested in regulation crowdfund offerings. That's pretty small. Now, 2020 has totally changed that. I just saw a statistic the other day that showed that almost $240 million went through Reg CF offerings just in 2020. That's almost a third of what we've seen in the whole 5 years since Reg CF was available. So it's really starting to take off because people are recognizing there are businesses in my neighborhood that need help. How do I help them? And businesses are saying, I need help, and starting to connect the dots with these regulation crowdfunding type offerings. So that's a way for everyday people, not just those who would qualify as a venture capitalist or an investor in a venture capital fund or an angel investor. Anyone can invest in these businesses through regulation crowdfunding.
There's a question that came, I think you started to answer. Can you distinguish venture capital from patient self-liquidating, quote, equity capital, thus distinguishing equity from debt?
Yes. So equity and debt are the ways that you invest. So you can invest in a business by giving, debt is a loan. You can invest in a business by making a loan to them. Typically that means that you give them the money, and within the next month or the year, they have to start making regular payments back on that loan at a stated rate of interest. And you can calculate what your rate of return is, because like I lend you $10,000 at 5% interest over 3 years. That's going to work out to, this is my total investment. Equity, on the other hand, is where that's considered risk capital, because you're investing in the business, and typically what you get is some stock. That's how people think. That's the easiest way to think of it. You're getting some stock or some shares of stock, which translates into ownership of the business. So maybe the $10,000 investment now gets you, a 5% ownership stake in the business. And the way that you get your money back from that kind of investment is there has to be this thing called an exit. And usually that means at some point the business is sold. It's acquired by a bigger company. Maybe it merges. It's somehow sold to another company or entity, and then the money from that sale gets divvied up among all of the shareholders, all of the owners. So that's where you don't know what your return is going to be until someday in the future, because you don't know what the purchase price is going to be until someday. That's why it's riskier, and that's that's the format that most venture capital investors will use. They'll use an equity. They'll take an equity stake in a company, is the way it's called. So they'll take an ownership stake, and hope that they can find, somebody who's going to buy the company for lots and lots of money. But kind of back to my explanation of the algorithm with venture capital, what they're expecting of their 10 investments and the 2 that are going to be home runs, what they want those to deliver is 10 times their money that they're investing, 10 times their money in 5 to 7 years. So, you put in, and venture capitalists don't put in $10,000. They put in, so they put in $1 million. They want to see $10 million in 5 to 7 years.
So so I get what's not working. And one of the things that's working is crowdfunding, which you've done some advocacy work in order to make that and other forms of patient capital be allowed. You want to talk either about the advocacy or about the alternatives, the other alternate paths that you are working on in terms of patient capital?
Yeah. So, so part of what that I'm trying to work on, and part of the problem, is this very structure of the capital, the very nature of equity that requires some kind of exit. I tell the story about Ben and Jerry's in the book. I think it's a great illustration of what happened with Ben and Jerry's. So everybody knows Ben and Jerry's ice cream, right? That's our nice Vermont success story up here, or not, depending on how you look at it. So Ben and Jerry's, in the I think it was the late 80s, early 90s, took the company public. That's another way that a company can have an exit. Instead of selling to, instead of somebody selling to Google, maybe they do an initial public offering on the stock exchange and people can buy stock in it. So that's another way that you can have an exit. So that's what Ben and Jerry's did. And so a lot of their early investors got their exit when they took the company public. Ben and Jerry were still involved though. And when you take a company public, it completely changes a lot of times how you structure your company and who has control. That's the thing. Now, all of a sudden, a lot of their big investors are also on the board of directors, kind of like what happened with me. You get these investors on your board of directors and they have control. And, fast forward to around 2000, Ben and Jerry's is, growing like gangbusters. And Unilever and some other companies come to them and say, hey, we want to buy you. And Ben and Jerry said, we don't want to be bought. And their investors say, too bad. We want to cash out and we want to sell to the highest bidder. And Ben and Jerry did try to rally enough private investors on their own to counteroffer the Unilever bid, but they weren't able to do that. And because the board of investors and the shareholders in general had that control over the company, they could make the decision that no, we want to sell to Unilever, and that's that. So equity is an issue because it puts power, it puts control in the hands of the investors and takes it away from the management and the owners of the founders of the company. So are there other structures than equity? Yes, there are.
So we want to keep the capital more local, more invested in women and people of color. And yes, there are. Sorry, I just interrupted the yes, there are. Go for it.
Yes. Yes, so there are lots of other structures that can be used that are more patient and more equitable in terms of making sure that control of the company stays in the hands of the people who really know what they're doing in running it. And those are typically the founders or the managers that are brought in. So and I do talk about this some in the book, and I don't want to get too technical and financy and all of this kind of stuff, but just to know that there's something called convertible debt, which is kind of like a loan, but it gives a little breathing space to an entrepreneur to not have to make a loan payment. In the early days when you're starting your business, when you get capital and when you're starting to make sales, you don't want to have to put that money towards paying off a loan. You want to be putting it towards growing a business. A convertible debt or a convertible note, either, can use that either way, can do that, can help you do that. So that's one structure. Another one that's starting to gain popularity that I really like, it's called revenue sharing. And it's like a royalty payment. I think royalty is probably the technical term, but revenue sharing, I think, is more descriptive. It's kind of like debt, but the business, the way you can structure it is that the business only repays when it has the profits to be able to do it. So it gives, again, that flexibility in the early stages when most of the capital in the business, you want to put it towards growing the business, not paying back your investors. But it gives you, as the company does well and becomes profitable, the investors get paid back. And that's, it's a little riskier than a loan. So it usually means there's a little bit better return to the investor than a typical loan. So we're going to start seeing more and more of these kinds of structures, if I have anything to do with it.
So yeah, talk about your next steps.
Yes. So a couple of things. A point on crowdfunding. I'm a huge fan of crowdfunding, of course. I wish it had been around when I had started my business. After I started my business and before the Jobs Act kicked in 2016, I was able to start a crowdfunding platform here in Vermont under state regulations, because before the SEC got their act together and finally did it at the national level, Vermont and now 36 other states have state-based regulations that allow you to do crowdfunding just from your state residence. And so that's what Milk Money is. It's a crowdfunding platform. It's hard to know, but we think it might have been the second crowdfunding platform in the country. The first one was a similar type platform started out in Oregon called Hatch Oregon, and we kind of grew up together doing this. And so Milk Money, in the 2 or 3 years that we ran campaigns, we helped 8 companies raise over $400,000. So it might not sound like a lot, but to these companies, helping startups raise anywhere from $25,000 to $100,000, that's a big boost. And several of those companies are most of those companies I think are really going strong today because of that early boost from their friends and neighbors who believed in what they're doing and wanted to contribute to it. Now, so why am I not doing Milk Money anymore, you ask? One of the things that we started to realize is that crowdfunding is hard. I'm just going to put that right out there. For both the business owner, the entrepreneur, and for the investor. For the business owner, it's hard because, you've really got to be out there shaking the trees and with your social media campaigns and everything you can do to try and get people to come to this platform and invest in your business. It's a lot of work to capture the eyeballs and the hearts and then the checks of these people. So that's a lot of work on the business side. It's a lot of work on the investor side. I'm a finance geek. I know how to do this stuff. I've invested in businesses doing this, and it's a lot of work to go back to a platform all the time and seek out these companies, and you got to be always on it. So I think that's one of the reasons why crowdfunding hasn't taken off as much as it has until this past year. But this past year, people had a lot of free time to look into this. So how do we fix this? The next phase, I believe, is to kind of aggregate crowdfunding into these local community investment funds. Can we create a way for, I call it a community mutual fund, and I have to put it in quotes, and I'm sorry for people that hate air quotes, but I have to do that or the SEC can come tearing down my door, because a mutual fund is a very specific legal structure. And right now, SEC regulations don't allow for it at the local level and in ways that allow but I'm going to give you another term here, a non-accredited investor to participate. This accredited, non-accredited thing is important. Accredited investors, it's a designation created by the SEC and IRS that the kind of the rules around it are that an accredited investor is anyone who has $1 million of net worth, not including their home, and or $200,000 a year of annual salary for the past several years, and the expectation that that will continue, or $300,000 for a couple. So that's those folks that meet those criteria can invest in any business they want, anytime they want, local, through the stock market, like anywhere. If you're not an accredited investor, which 95% of Americans are not, it's very, very hard. It's difficult to make these direct local investments. That's why most of us put our money into stocks and mutual funds and things that are traded on exchanges, on public markets, public exchanges. In fact, I think the statistics I've seen is about $56 trillion. Americans have $56 trillion invested in stocks, bonds, mutual funds, their pension funds, that kind of thing. None of that really is going into these direct local investments because the SEC has made it difficult for non-accredited folks to make these direct local investments. So that's what I'm trying to change. Last spring, I headed up a task force, pulled together a task force to propose some policy changes to the SEC to make it easier to create these local community investment funds. And we submitted our policy change, our policy proposal at the end of October. And then, there's some weird stuff that happened in November that kind of had everyone preoccupied a little bit. And now we've got a new...
Wonderful.
Yes. Opening up new doors and bringing in a new commissioner for the SEC. So we've been waiting for that dust to settle. And now we're getting ready to start moving forward. In fact, I have a meeting with the task force this afternoon to start pushing this forward again. And what it will do, it will allow communities the ability to aggregate capital. It means like you and I could come together, or not you and I, because we're in different communities, but all you folks down in Atlanta could maybe invest together into a fund, and then you have you have somebody who knows how to do this stuff. The fund would pay a professional manager so that you all don't have to do what's called the due diligence on all these different companies. The manager says, I'm going to look at all the different investments here. I know that this, like, all my investors want me to focus on supporting Black women entrepreneurs. That's our social mission with this fund. Great. So the fund manager would then do all of that and would invest the money on behalf of the fund. And so it just makes it a lot easier on both sides. Because now for the investors, all you have to do is just make sure that the fund is something you believe in and that you believe that they're going to invest your money the way you want them to. For the entrepreneur, now you don't have to go to hundreds of people to get the money you need. You go to this one fund and you talk to them. So that's what we're working towards. And the exciting thing is that there are already some groups doing work along these lines. It's not that there are some limitations. I'm not going to go into them here. I'll say enough to say there are groups that are doing work like this now. They're limited to only making loans. They can't do a revenue share. They can't do convertible debt. They can only do loans. But still, they're doing great work. And Atlanta has like lots of stuff going on. I'm going to share my screen again. And I'm going to find, okay. There we go. Oh, did it come up?
Yeah. Boston Impact Initiative?
Yes. Okay. So that didn't work. I want you to see this because, yeah.
I'll recap some of the things you've been saying that I've been hearing while you're looking for it.
Okay. Okay.
You got it?
Yeah, well, it's not letting me scroll down. Suffice it to say, so here we have the Boston Impact Initiative is a fund that's been in Boston, in the Jamaica Plain region of Boston since 2016. And it has been providing loans to Black and Latinx and others in the Jamaica Plain region of Boston for 5 or 6 years, and doing great things, helping businesses to get started. They're just a wonderful success story. And because they've been so successful, they say, hey, maybe we can help other communities do the same thing. So they've started this fund building cohort. And what you can't see if you scroll down on this page, which we can send you the link, there are 30 folks participating in this cohort to set up similar type funds in their region. 4 of them are from Atlanta. 4 doing really cool stuff. Village Microfund, the Guild, Atlanta Wealth Building Initiative, Invest Atlanta, all of them doing very cool stuff. Yes. Now, for those of you outside of Atlanta, thank you for putting those in the chat. This is going on all over the place. So you can go to the Boston Impact Initiative and look at who else is in that cohort. There are already some examples up there. And let's see, I think I might try this again with another thing. Here we go. So I have built a website Okay. Are you seeing investor groups from the local investor?
We are.
So this is a directory of investor groups all around the country. I think we have almost 60 on there so far, and we're always looking to add more. And so you can go in there, you can search your zip code, you can search your city, and see if there's anything around you. And then the links will take you through so you can find out what might be going on in your neighborhood. And these are all groups that are starting to figure out ways to aggregate community capital and invest it back out into the community. Once we get this policy change pushed through with the SEC, it will give so many more options for how you can do those investments. So it's exciting to see the progress.
Yeah, it is progress. Talk about the next steps that you're taking, not only to do the advocacy work with the SEC, but also to do the research in order to smooth the way. I'm an organizational consultant, so I love this idea that it's the wild, wild west, right? We only have one way of doing things now, and you have the tools and the vision along with others of what are the paths that it's going to take in order to achieve the end result, right? Which is regenerative finance and an equitable system. So the advocacy, so we can invest in these local funds, which you referenced us to. The advocacy work that you're doing is to change policy so that the more patient capital is a possibility. And what's the other prescriptions?
Yes. So, well, oh my gosh, so many different things. I do want to add into some things of kind of what's going on right now today and actions that people can take today, in addition to checking out these funds that might be available in your area. An easy first step is to think about where you bank, because banks do make loans. They tend to make loans to more established companies. So, not great for entrepreneurs or startups, but once they get to a certain place, local banks especially have been doing really great work in helping local businesses to grow and thrive. And so local banks need capital from people who are putting their money into those local banks to be able to do that. So, in the past, when I've made this recommendation, I have gotten some pushback of people saying, it's like, either I don't have a local bank, or, there's this local bank, it's great, but it's not convenient because they only have, 3 branches in my region or whatever. With the advent of mobile banking, it's changing things, and it's really making it a lot easier for depositors to have the convenience they need in reaching their bank. And their ability to then put their money to work in their community. There's a great website called banklocal.info. You go and you put in your zip code, and it will bring up banks in your region and rank them on how good they are at doing small business lending. Do they have headquarters? Are they in your region? Are they mostly hiring people from within your region? Are they extracting capital out to a big national headquarters? So that's step number one, and that's usually what I recommend for people to get their feet wet with this. The other thing, in addition to the directory, there are, well, I don't think I'm going to go down that path. I'll just mention it quickly. There are organizations called Community Development Financial Institutions. CDFI is the acronym. Again, doing phenomenal work, especially important now. The CDFIs they really got going in the 90s, and under the Clinton administration, put some stuff in place to really jumpstart more CDFIs. And these take the form of, like up here we have the Vermont Community Loan Fund, which is one of the oldest community loan funds in the country. I think New Hampshire Community Loan Fund is a little older, but they've been around 30, 35 years. And they are, again, they're loan funds because that's the easiest, that's the path of least resistance with the SEC right now for getting capital out there. But they allow people like me, like I can invest money into the Vermont Community Loan Fund, and then they lend it out to local businesses. They're usually willing to take a little bit more risk than a bank. They don't necessarily go with startups, but they will provide capital to smaller businesses, and they're doing a fantastic job. And so there are tons of ways that you can look for CDFIs in your region to perhaps invest in. Now, not all of them allow non-accredited investors, unfortunately. That's another thing we're trying to change, to get them thinking about, allow the community to invest in you so that they can then indirectly invest in the community. So it's another thing to think about. And then the last thing the big thing that I'm working on now is getting back to this question about debt versus equity, and everything in between, and what else is in between. There's really not many resources, if any, that spell all this out for people who want to make direct local investments. So, if you're thinking about it and you're like, yes, I want to do this and I'm going to make a direct investment, there are not many resources out there to help you understand how best to structure the investment to really do what you want it to do. So that's a project that I am hoping to get up and running under the nonprofit that I started 3 years ago called the Initiative for Local Capital, to create what I'm calling a sustainable securities rubric that people can look at and say, here's a company that meets these criteria. This is the best way to structure an investment for the company where it is in its life cycle and for its long-term goals, and so that I can get the kind of return on my investment that I want. So that's something that I'm currently fundraising for, if anyone's interested. Thank you. But it's exciting to see the acceptance of this, or the awareness among folks that are in the impact investing community, saying, oh my gosh, yes, we really need that. And so I'm excited to get that project up and running soon.
That's great. We've got 3 questions from our folks. Could you distinguish your fund concept from an investment club as defined by the SEC?
Yes, great question, because they are very different. An investment club is a structure that is allowable under current SEC regulations, and of course, with restrictions. Let's see, I'm going to make sure I get these all right. Typically, an investment club is a group of people who come together, pool funds together to invest together. You are limited in the number of people you can have in this club. You can have up to 99. If you go over 99, you are now considered an investment fund, and you run afoul of the SEC. So you got to be really careful with that. Also, the investment club, you need to be able to demonstrate that all of those folks who are investing are taking an active role in deciding how the money is invested. So it's not the kind of thing where you can say, hey, let's just go hire a portfolio manager to do this for us.
That makes sense.
Yeah, I mean, you might be able to, but you'd have to really document that, every member is supposed to be actively involved in the decision-making process. So that's why they call it a club. And so, and there are tons of these around, and they're great. There's one that I love. It's called the Circle of Aunts and Uncles. And I saw somebody on here from Philly. So this is one that was, I think, if it's not started by, it's certainly given momentum by, oh my gosh, her name just went out of my head, from the White Dog Cafe, Judy Wicks. Judy Wicks created the Circle of Aunts and Uncles. They, so they're like, I'm your rich aunt and uncle, whatever. So they all get together. They have pictures on their website. It's adorable that they get together and over wine and a meal, because of course Judy Wicks is a very famous restaurateur in Philadelphia. So they always have great food, and people come and talk to them. It's very informal, and they make investments in this business, in their businesses. So that's a great way to get started. And I know I'm actually working with a couple groups, one in Brooklyn and another group out in California that's thinking of starting an investment club. And then when we get these rules changed at the SEC, then they can evolve into a fund.
Oh, that's cool.
Yeah.
Hey, talk about the disruptions in the stock market with the trades like GameStop and how that relates or doesn't relate to this sort of intent. Is there the desire? Do you think the desire for a more direct relationship to trading in the market comes from the same place you're talking about, or a different place?
I think it comes from the same place. I wrote a blog post about what happened, with kind of what's going on there. And, because I looked into, and just reading some of the motivations of some of these Reddit inspired, Wall Street Bets inspired investors, and many of them saying, we're not doing this to get rich. We're doing this to prove a point. There are a number of people who participated in that activity because they wanted to demonstrate that that there's stuff going on in the hallowed halls of Wall Street, that the little guys have been left out of for so long. Well, guess what? The little guys have proven themselves pretty smart in figuring out how to game this system. I love what how it got started and the collaborative effort that it took using social media to come together and figure out how to do this. I think it shows a weakness in the kind of the hierarchy of Wall Street, and it shows that there are a lot of folks out there who want to be able to participate in what's going on with our economy and how to invest directly in our economy, and not feel like they're being excluded by this hierarchy.
I'm going to close with what an example of what comes closest to the community mutual fund model. I think, I have a good one. Okay. So, Boston Impact Initiative, which I mentioned, was a pioneer, along with, there's another one in Massachusetts called Pioneer Valley Grows. Pioneer Valley. They were really pioneers in this movement toward aggregating funds together to invest together with professional management. They're both loan funds. Boston Impact Initiative, which I'm going to call BII,
because it's easier. So BII then started, the folks there started thinking, we're limited to doing loans. Is there other, are there other ways that we can try to deploy our capital? And can we be doing more to attract the kinds of investors that will benefit from this wealth creating opportunity? So not just trying to go out to all the rich folks in Boston to say, invest in our fund because we're going to invest in these businesses. They want to get the actual folks within a community that maybe can only invest $50, not $50,000. So this fund, it's called the Ujima Project. UJIMA. It's not even a project anymore. It's the Ujima Fund. And they, oh my gosh, they're such a great success story because they are not only focused on how can we get more and better capital out into the market, but how can we create democratic access to wealth building opportunities for the folks of Boston and Jamaica Plain. So they're really focused on both sides. So it's not just the rich people putting money in to help the people that need money. It's let's bring everyone along. Let's give everyone a way to access this by making lower minimums and by finding other ways to engage the community in investment. They're doing great stuff. I can't wait to see how they continue to grow and thrive.
I'm so glad we got the question. Are there final or other thoughts we haven't touched on?
I'm just reading through some of these, and I see Eric DeLucas sending so many great comments here. I think I'm feeling a little talked out. But like I said, as ER mentioned, I co-founded a national nonprofit called the National Coalition for Community Capital. And there are only a few of us founding board members left. And I often talk about, it's like, remember when we used to feel like we were just these lonely voices in the wilderness and we had to come together to talk to each other because, nobody else would listen to our crazy ideas. Now everyone is. It's really exciting. And it's needed. If anything that we've learned from this past year of just so much that has happened in our economy and the local businesses that are such an important piece of the fabric of our communities, that they need our support and we have the power to help them. I think that's what I want to leave you with. We can do it.
I honestly can't remember if we were ending at 1 or if we were ending at 1:30.
Yes.
Yours, come tell me.
Yes. Yeah, we are ending at 1 because this is just our special luncheon hour. And I think, really trying to get a bite-sized kind of intro to this topic, but we want to invite folks. This teal button at the bottom of your screen allows you to buy Moving Mountains directly from Charis. We always appreciate when you buy books directly from us. It really helps us. We do have sort of alternative economics books at Charis. So if this is something you're interested in, our business section is very heavily weighted towards these kinds of books. We do not carry traditional business books, but we carry books that are really about, how do we creatively empower more and more of our community members to have equal access to wealth and really rethink what wealth looks like in a healthy, sustainable, and feminist way that's not based on exploitation and harm. So I love the concepts that y'all have explored today. I'm really grateful to both of you and to everyone who asked such great questions. It is also my job as the executive director of Charis Circle to remind folks that we are a nonprofit and to ask for money always everywhere I go. So one of the ways that we remain sustainable and connected to our community is that we are primarily individually donor funded. So we have really stayed well resourced by receiving contributions of $2, $3, $5 from tens of thousands of people. So the model that you envisioned, Janice, for your business really resonated with me because that's been so much of how we have raised capital through the years, as opposed to going after grants and foundation money, which, you know, is very hit or miss sometimes, particularly for a radical organization. So I know firsthand that it is possible, but it's hard. And I appreciate the reality check of the both and. It is absolutely possible, and we have to build it together. And it's all a lot of work. So I am grateful to both of you, Pam, for your work in Atlanta. Folks who are not from Atlanta may not know as much about your work, but I know that people in Atlanta know how much you do for our nonprofit and philanthropic communities. So thank you for that. And Janice, it's lovely to meet you. So I'll be adding captions to this and putting it up on our YouTube channel within the next 24 hours or so. And I'll tweet that link out. And we'd love for y'all who are watching to share this with other folks who you think might enjoy it, because it really helps us, you know, get the reach out. And there may be folks who are working right now who couldn't join us. So please stay tuned. But until next time, thank you so much for being with us. And I hope y'all stay well. And maybe we can gather physically together sometime in the future.
Yeah. Thank you so much, ER, and to Charis, and for bringing us all together for this talk today. It's been a lot to me to be a part of your community for just an hour today, and I hope to maybe see you soon.
Thanks to both of you and everyone.
And thank you, Pam. Yeah, this was fun.